Most crises in history have one thing in common. Everyone thinks everything is fine, until suddenly it isn't. People are going to work, the stock market is green, the headlines say, resilient economy. And then, almost overnight, the narrative flips from everything is under control to how did this happen? Today, the starting point is a simple paradox. What if the financial system we trust, the one we lean on to save for retirement, to invest, to protect our families and our future, is not built on strength at all? What if it's built on trash? Not trash as an insult. Trash in a very specific sense. Debt that can't realistically be repaid. Assets that can't be honestly valued. And trust that can't be sustained once people start asking the wrong questions. If that's true, then the real question is not, will the system collapse? The real question is, what breaks first, and how much time do we really have? To answer that, we have to go back to first principles, to the roots of the system that almost no one wants to look at directly, because once you see it, you can't unsee it. For years now, you've been hearing a very familiar storyline. The economy is strong. The labor market is solid. Consumers are still spending. Confidence is coming back. On the surface, it sounds reassuring. It sounds like the kind of story you want to believe, especially if you have a mortgage, kids in school, a 401k, and a life that depends on things not falling apart. But that's just the surface. Ordinary people, you, your co-workers, your friends, only see that surface. The job reports, the market indices, the talking heads on TV saying, we're in a good place. The people inside the system are looking at something very different. They're looking at the plumbing, the hidden pipes, the structures that never make it onto cable news. And quietly, they've started using a very uncomfortable word, cockroaches. In finance, cockroaches is not an insult. It's a warning. It means, if you see one, there are always more hiding in the walls. One bad fund, there are 20 more. One unexpected loss, there are dozens that just haven't been forced into the open yet. The scary part is that a lot of the people who are usually bullish by default, the ones paid to always sound optimistic, are starting to see cockroaches everywhere. To understand why, you have to step into the shadow world behind the official system. The world of shadow banking. This is the part of finance that doesn't look like a bank, doesn't call itself a bank, but behaves like one. Borrowing short, lending long, slicing risk into complex products, promising stable returns out of assets that are anything but stable. It's a place with almost no real-time supervision, no standardized rules, and very little transparency. But it holds trillions of dollars in loans, credit, and synthetic exposure that regular banks either can't or won't hold on their balance sheets. Why did this world explode in size? One big reason, after each crisis, regulators crack down on traditional banks. They tell them, you can't take this much risk, you can't hold this kind of asset, you must meet these capital ratios. Banks respond by tightening lending. But the money looking for yield doesn't disappear. It just looks for a different path. Capital is like water. It has to flow somewhere. When traditional channels get blocked, it finds the cracks in the wall. In this case, the shadows. In the last decade, and especially after 2020, a huge amount of lending migrated from the visible banking system into non-bank lenders. Private credit funds, direct lending vehicles, structured products, and complex investment funds that act like banks without being treated like banks. When a risky loan, a complicated project, or a distressed asset becomes too ugly for a normal bank, it often doesn't die. It just gets repackaged and sent into the shadow system. Imagine a household that refuses to throw anything away. The broken chair, the old clothes, the cracked TV, instead of going to the trash, they're all pushed into the attic or the basement. On the main floor, everything looks clean and organized, but one day the weight of everything hidden above your head and beneath your feet becomes too much. In financial terms, that attic is shadow banking. Quietly, banks move exposures off their official balance sheets. Loans are sold, securitized, or transferred into vehicles that are technically separate. On paper, risk is reduced. In reality, it's just been moved where fewer people can see it. It's like sweeping trash under the bed before the guests arrive. The room looks neat, but the trash is still in the house. At the center of this shadow world is something that sounds boring, but might decide your financial future. Private credit. For years, private credit was marketed as the cool, alternative way to earn higher yields. Can't get enough return from treasuries or regular bonds? Put money into funds that lend to companies directly, often at higher interest rates, secured by collateral that supposedly protects investors if something goes wrong. Pension funds, insurance companies, endowments, foundations, and wealthy individuals poured money into these vehicles. The sales pitch was simple. Banks are retreating, so we're stepping in. We know how to underwrite risk. We're filling a vital gap in the market. On the surface, it sounded like innovation. Underneath, a lot of that credit started to look like the same old story: more leverage, weaker protections, rosy assumptions, and structures that work beautifully in good times and become traps in a stress event. This leads to one of the most misunderstood points about market crashes. Most people think markets collapse because prices go down. They imagine a slow, grinding decline in value that eventually triggers panic. But in real crises, that's not how it works. Markets don't implode because assets gently lose value. Markets implode because liquidity disappears. Liquidity is not the same thing as price. Liquidity is the ability to turn an asset into cash at something close to the last known price. A market is healthy when you can say, "I want to sell," and there's someone on the other side willing to buy. A market becomes deadly when suddenly there are no real buyers at any reasonable price. The problem isn't that something is worth 100 one day and 95 the next. The problem is when you go to sell and realize that anyone still willing to touch it is only bidding 60 or 50 or nothing at all. That moment happens when trust in collateral breaks. In modern finance, almost everything rests on the idea that collateral, what you put up as security for a loan, can be fairly valued. A building is worth this much. A bundle of loans is worth that much. A fund's assets can be estimated with models, and those models allow lenders to say, "We're covered. Even if times are rough, we'll be okay." When that belief cracks, valuation itself starts to vanish. It's like a light switch. One day the system is happily trading, rolling over loans, extending credit. The next day, someone looks closely at what's actually in the box and says, "Wait, what if this stuff isn't really worth what we say it is?" That doubt spreads faster than any virus. Suddenly, buyers step back. They don't want to be the last one holding something that might turn out to be toxic. Funds that promised investors they could get their money back on demand or on a schedule now discover they can't sell their assets, at least not without taking huge losses. So what do? They do the one thing that reveals just how fragile the situation really is. They lock the exits. Imagine you're an investor in a private credit or real estate credit fund. For years, you've been told, "This is a great diversifier. It's not volatile like the stock market. You'll get steady income, and you can redeem on a regular basis." Then stress hits. Some of the loans in the portfolio stop paying on time. Some borrowers need extensions. Some projects go over budget. Suddenly, redemptions spike because a few investors don't like the smell of smoke and head for the door. The fund managers look at their portfolio and realize that if they sell today to meet all those redemption requests, they're going to have to dump assets at fire sale prices, prices that could trigger even more panic and force them to admit losses they thought they'd be able to hide or manage over time. So they make a decision. Temporary gates, suspending redemptions, putting in withdrawal limits, stretching timelines. In plain English, they're saying, "You can't get your money out now, maybe later, and probably not at the value you thought you had." To translate that into something personal, imagine walking into your bank, asking to withdraw $100 from your own account and being told, "We'll give you $80 and you can have it in 2 years." That's not investing. That's being trapped in a burning theater where the doors have quietly been chained from the outside. And the important thing to understand is, the first time you see this happen publicly, that's not the whole problem. That's just the first cockroach running across the kitchen floor. Behind the scenes, there are more funds with liquidity mismatch, more structures that promise daily or quarterly liquidity on assets that might take months or years to sell at a fair price. More portfolios that only look stable because nobody has yet tried to liquidate them in size. The system doesn't break when everything is fine. It breaks at the point where a relatively small number of people try to get out at the same time and discover the exit isn't designed for that. Now layer something much bigger and more exciting and more dangerous on top of all this. Artificial intelligence. Almost everyone agrees AI is the future. That's not the debate. The debate is about timing and cash flow. The way markets are investing in AI right now, you would think we are already living in 2050. You see mega-scale data centers, each costing tens of billions of dollars. You see startups with almost no revenue, sometimes not even a clear business model, raising money at valuations in the billions. You see a supply chain for GPUs and advanced chips stretched to its physical limits. Electricity grids being redesigned. Entire industrial strategies being bet on the assumption that AI will generate massive, sustained, predictable profit streams. But revenue and real, durable profit haven't caught up with the story. Right now, AI is incredibly powerful at pattern recognition, language modeling, and automation of certain cognitive tasks. But it is not yet truly intelligent in the way that justifies the scale of bets being made. It simulates thinking. It does not think on its own. More importantly, from a financial perspective, it has not yet produced cash flows anywhere near the magnitude of the capital being deployed. The debt that funds these data centers is very real. The monthly interest payments are very real. The operating costs, from electricity to cooling to maintenance to software engineers, are very real. The projected revenue that is supposed to justify all of this, however, is still hypothetical. It depends on adoption curves, pricing power, regulatory outcomes, competitive dynamics, and business models that might look brilliant in a slide deck and totally unstable in reality. In this environment, a lot of the infrastructure build-out for AI is being financed with credit, project loans, structured deals, off-balance sheet entities, and creative arrangements designed to spread the cost over time and keep the headline numbers looking manageable. Wall Street is very good at this. When a company doesn't want to show a gigantic capital expenditure number on its income statement, there are vehicles and structures that can hold the debt elsewhere, even though the economic risk is still attached. That doesn't mean AI is fake or useless. It means that the way we are financing the AI revolution has many of the classic signs of a bubble. Huge upfront spending, minimal immediate return, and an assumption that later will be so profitable that all the current risk will look smart in hindsight. History shows that bubbles don't need to be based on something totally worthless. The underlying technology can be very real. The bubble comes from expectations outrunning reality. A bubble doesn't need asset values to be 100% wrong. Often, it only takes a 10% downward reset in expectations to trigger forced selling, margin calls, and a cascading loss of confidence. So now, step back and look at the system as a whole. You have 3 major points of fragility. First, the pile of questionable debt. The trash debt, distributed across shadow banking, private credit, and complex structures that only work if everything goes right. Second, the liquidity problem. Investors who think they can get out whenever they want, backed by portfolios that cannot be liquidated without inflicting massive damage, either on themselves or on the market. Third, the AI bubble being inflated with cheap or semi-cheap credit on the assumption that future profits will bail everything out. Each one of these, on its own, would be a serious source of risk. Together, they become a tightly coupled system, a set of bombs wired to one another. Picture it as three connected dominoes. When one falls, it doesn't just stop there. If the trash debt begins to crack, meaning defaults rise, restructurings spike, and recoveries are lower than expected, private credit funds come under pressure. As they come under pressure, investors try to redeem. To meet those redemptions, funds either have to sell assets into a thinning market or gate withdrawals. If they sell, prices fall, which then damages the marks held by other funds and institutions, causing more redemptions and more panic. If they gate, trust in the entire category gets hit, and investors start asking hard questions about every similar product they own. As confidence drains from private markets, stress bleeds into the plumbing of the system. The repo market, short-term funding, collateral chains. Banks, seeing rising risk, hoard cash, tighten lending, and pull back from anything that looks even slightly questionable. Companies that depend on rolling over short-term funding suddenly find they cannot refinance on acceptable terms. Projects are delayed, payrolls are at risk, investment plans are shelved. At the same time, if the AI narrative takes even a modest hit, maybe a major player misses revenue expectations, or regulators clamp down on data usage, or customers simply don't pay as much as hoped, valuations across AI-adjacent assets can reset lower. That puts pressure on the collateral supporting AI-related loans and structures. Anyone who financed AI infrastructure with optimistic assumptions about utilization and pricing now has to go back and rerun the numbers. Lenders start worrying about their exposure. Some refuse to roll financing at old terms. Some demand higher rates or more collateral. The cost of capital rises precisely for the projects that were already stretching the limits. Once again, stress in one corner of the system ripples into others, because large institutions, from banks to pensions to insurers, are often exposed to all three. They hold private credit, they finance or invest in AI, and they sit at the center of the funding networks that keep money flowing. This is how a feedback loop forms. Private credit loses liquidity. Investors pull money or try to. Funds gate redemptions. Short-term markets feel the strain. Banks grow more cautious. Credit to the real economy slows. Companies struggle to refinance. Some cut jobs. Some default. That hurts the value of the loans and bonds held by the very same funds that were already wobbling. Pensions see funding ratios deteriorate. Insurance balance sheets come under more scrutiny. Everyone suddenly wants to be more conservative at the exact moment when being conservative means pulling back from risk, which is also the moment that pulling back from risk can turn a slowdown into something close to a freeze. Economic growth doesn't gently slide from 2% to 1.5%. It can slam into something that feels like zero, not necessarily in the official GDP numbers right away, but in the lived experience. Hiring stops, projects die, credit lines are cut, and wait and see becomes the default stance of every decision maker. At that point, the danger is that we move from a financial crisis, where the problem is bad debts, into something closer to a currency or money flow crisis, where the real issue is that money stops moving. Most people think of crisis as too much bad debt. And that's part of it. But there is another, more dangerous layer, when institutions no longer trust not just the value of specific assets, but the reliability of each other's balance sheets. When a bank, a fund, or a large corporation looks across the table and silently asks, how much of your collateral is real and how much is trash, and cannot answer that question confidently, the rational response is to stop trading, stop lending, and pull back. On paper, markets may still be open, prices may still be printed on screens, but if the size you need to transact without moving the market disappears, if liquidity is only there at fantasy levels, then functionally the system is paralyzed. This kind of paralysis is more dangerous than a simple crash. In a crash, at least you have prices, even if they're painful. You can make decisions. You can rebalance, cut losses, redeploy. In a frozen market, you have uncertainty layered on top of loss. You don't know what your assets are really worth because nobody is transacting in size at arm's length prices. You don't know which counterparties you can trust because everyone is hiding behind mark-to-model valuations and temporary measures. You don't know whether the liquidity you assume you have, in a fund, in a line of credit, in a facility, will actually be there when you try to use it. That is when rational actors start behaving in ways that look irrational from the outside, but make total sense from the inside. Hoarding cash, dumping anything that can be sold, refusing to extend credit even to names that should be safe. The system doesn't break cleanly. It seizes. Now here's the part that almost everyone gets wrong when they think about who pays the price. It's tempting to imagine that when this kind of thing happens, it's billionaires, hedge funds, or big-shot traders who take the real hit. They certainly take some damage, but the group that often suffers the most is the ordinary working population. The reason is simple. Who owns the long-term pools of capital that are feeding this machine? Pension funds, public employee retirement systems, teachers' funds, union funds, insurance products sold to families, 401k target date funds that allocate to alternatives in search of higher returns. These vehicles are some of the biggest clients of private credit and shadow banking structures. They are the patient capital the system loves because it looks sticky and long-term. When everything is calm, that's fine. When the chain starts to break, that capital cannot move fast. It is trapped in structures with long lockups, complex withdrawal rules, and limited transparency. And when the dust settles, it is often that capital that gets the letter in the mail. Benefits reduced, payout assumptions adjusted, funding shortfall, contributions need to rise. That's the teacher in Ohio who thought their pension was safe. That's the firefighter in California who assumed that after 30 years of service, the numbers would just work. That's the nurse, the truck driver, the city worker who never had the time or the training to dig into what alternative credit allocation really meant. They didn't sign up to be collateral in a complex, leveraged, opaque system, but in practice, they are. When cuts need to be made, it's rarely the billionaire family office that gets a letter saying, "We're slashing your retirement income." It's the people whose names will never make headlines. That's why this conversation is not just technical, it's moral. And that brings us to the true engine behind every crisis. Not math, but psychology. No system collapses purely because of equations. Spreads, yields, ratios, and models are all tools. What actually breaks is belief. Leverage creates the illusion of being richer than you really are. Consistent cash flow creates the illusion that something is permanent and safe. Financial statements create the illusion that complex risks have been tamed and quantified. As long as people believe those illusions, the system can keep marching forward, even if the foundations are slowly rotting. The moment that belief flips, when enough participants decide, almost at the same time, that they no longer trust the numbers, liquidity vanishes almost instantly. That's why, from the outside, every crisis looks sudden. Headlines say shock, surprise, nobody saw this coming. But beneath the surface, the warning signs were there for months, sometimes years. They were just ignored, explained away, or buried under narratives that felt better. So what separates the people who get wiped out from the people who come through a crisis stronger? It's not luck, it's timing and clarity. The critical edge is understanding what is really happening beneath the surface and doing it before the crowd. To build that edge, there are 4 foundations. The first is mindset. That means being willing to look directly at uncomfortable truths without panicking and without escaping into denial. It means not needing the world to be safe in order to function. If you emotionally require the story, "everything is fine," to be true, you will ignore the signals that say otherwise until it's too late. The second is liquidity. Cash is not lazy or wasted if it's part of a deliberate strategy. It is stored energy, optionality. In a world where others are over-leveraged and locked into illiquid structures, the person with real liquidity has power. They can wait. They can buy when prices are truly distressed. They can say no. The third foundation is preparation. Preparation means knowing in advance what you actually believe is valuable and what you recognize as foam. It means understanding the difference between an asset with deep, durable demand and a story that only works in an environment of free money and blind optimism. It means asking hard questions of anything you invest in. What is the real cash flow here? Who is on the other side of this trade? What assumptions need to be true for this to make sense? How does this behave if conditions reverse? Preparation is not about predicting exact dates or specific events. It's about knowing what you'll do when volatility arrives, so you are not improvising in panic. The fourth foundation is protection. Protection is about avoiding unnecessary leverage, avoiding opaque products you don't fully understand, and refusing to outsource all of your thinking to marketing materials and experts whose incentives are not aligned with yours. It also means protecting your own psychology, not getting sucked into the fear of missing out when everyone else is bragging about gains, and not collapsing into fear when prices fall. This brings us back to the decision point you are standing in right now. We are in a moment where trash debt is expanding in the shadows, where liquidity can flip from plentiful to vanishing much faster than most people expect, where an AI-driven capital expenditure boom is being financed with massive amounts of credit on the assumption that the future will bail us out, and where the people most exposed to the downside are often the least aware of it. Central banks and policymakers are not all-powerful in this environment. They have tools, but those tools are constrained by inflation, politics, and already elevated levels of public debt. They cannot simply cut rates to zero and print trillions forever without consequences. The system is, in many ways, boxed in. So the question in front of you is not, will there be another crisis? The question is, where will you be standing when it hits? Will you be in the crowded theater, laughing at anyone who points out the smoke because the movie is still playing and the popcorn still tastes good? Will you wait until the first person screams fire and everyone rushes the exit at the same time? Or will you be the one who pays attention to the small signs, the smell in the air, the heat in the walls, the nervous looks from people who understand the building better than you do? In every major reset of the financial system, wealth does not disappear in a simple, fair, evenly distributed way. It moves. It moves from the unprepared to the prepared, from those who believed the story the longest to those who quietly adjusted their behavior before the story broke. You cannot control the entire system. You cannot stop shadow banking from existing or derail an AI investment boom by yourself. But you can decide whether you are over-leveraged or not. You can decide whether your savings are trapped in structures you don't understand or positioned in ways that preserve flexibility. You can decide whether your plan depends on everything going back to normal, or whether it is robust enough to handle a world where normal itself is being rewritten. In times of reset, there are always people who lose almost everything, and people who emerge with more power, more assets, and more options than they had before. The difference is not that one group had a crystal ball. The difference is that they took the paradox seriously. They were willing to ask, what if this system isn't built on strength, but on trash? And then, instead of panicking, they quietly changed where they stood.